Markets are calm, stocks are rising, volatility is low. And yet, the world's top financial watchdog, the IMF, just issued one of its sharpest warnings since the 2008 crash. Their October Global Financial Stability Report says the system is dangerously mispriced. Investors are acting like the world is safe, while debt, leverage, and hidden risks quietly pile up under the surface. The last time the IMF warned this bluntly was in 2007, and we all know what came next. The question is simple. Why is the world so calm right before the crash? The IMF sounds the alarm in October. The IMF released its new Global Financial Stability Report, and unlike the diplomatic tone they usually use, this one was blunt. They warned that the world is showing overvalued stock markets, compressed bond yields despite massive deficits, fragile banks exposed to real estate losses, shadow banking risks at historic highs, derivatives exposures far beyond regulatory visibility, record global debt crossing $315 trillion. But here's the contradiction. Markets remain calm, almost calm. The volatility mirage, global volatility indexes like the VIX, are unusually low. Bond markets are quiet. Even crypto is stable. To the IMF, that's not a sign of health. It's a sign of complacency. They call it the volatility mirage. Investors think risks are low. When volatility appears low, investors mistake silence for stability, as if the absence of noise means the absence of danger. This illusion pushes them deeper into positions they barely understand, trusting a calm surface that hides a turbulent undercurrent, so they borrow more. Cheap leverage becomes irresistible, and borrowing feels harmless when markets look predictable. In reality, every new loan stretches the system tighter, increasing the speed at which everything can snap and take bigger positions. Positions grow larger, risk models become blind, and assumptions harden into beliefs. What begins as confidence quietly evolves into overconfidence and then into fragility, making the system more fragile. Layer by layer, leverage forms a hidden architecture of instability beneath the global economy. A system built on borrowed certainty becomes dangerously vulnerable to the slightest disturbance, until a small shock becomes a massive earthquake. What should be a minor fluctuation suddenly cascades through the network, triggering forced selling, margin calls, and liquidity evaporation. In a fragile system, tiny tremors don't fade, they amplify. 1997 Asia crisis. A currency wobble in Thailand became a multi-country meltdown within weeks, exposing how interconnected and leveraged the region had become. What started as a local issue spiraled into a continental collapse. 2000 dot-com crash. Tech valuations floated far above reality, sustained by hype and borrowed optimism until revenue failed to match dreams. The bubble didn't burst slowly, it imploded. 2008 financial meltdown. Trillions in hidden leverage sat beneath mortgage markets, unnoticed until the first cracks appeared. A single collapse, Lehman's, triggered a global freeze. 2020 pandemic liquidity freeze. Markets didn't crash because of bad assets, they crashed because liquidity vanished in hours. It was the fastest reminder in history that stability can evaporate instantly. Calm is not safety. Calm is the quiet before the storm. When markets go silent, it's rarely a sign of strength. It's the moment before reality catches up. In finance, calm doesn't signal stability. It often signals pressure building where no one is looking. The IMF's three biggest warnings. The IMF identifies three major danger zones. 1. Asset prices are detached from reality. Stocks are priced for perfection, future growth, low inflation, falling interest rates. But global data doesn't support this optimism. 2. Government debt is exploding. Major economies, the US, UK, France, Italy, Japan, all face record deficits. Yet bond yields are stable because investors assume governments will never default. That assumption is dangerous. 3. Shadow finance is outrunning regulators. Non-bank lenders, private credit funds, hedge funds, insurers now control more money than traditional banks. They aren't regulated, they aren't transparent, and they can break the system without warning. History is repeating. Flashback. The last time markets ignored risk in early 2007, the IMF warned that US housing looked stretched and mortgage products were getting dangerous. But markets shrugged. Wall Street kept partying. Investors believed the system was too strong to fail. What followed was the worst financial crisis since the Great Depression. Lehman collapse, bank runs, foreclosure signs. Today, the IMF's language feels familiar when stability becomes instability. Economist Hyman Minsky described a phenomenon now called the Minsky paradox. The longer things look stable, the more unstable they actually become. Why? Because banks borrow more, hedge funds leverage more, governments issue more debt, retail investors take bigger risks, corporations buy back shares instead of building buffers. Stability encourages risk-taking. Risk-taking creates fragility. Fragility eventually causes collapse. We are living in a classic Minsky environment. Central banks are out of ammunition in the 2008 crash. Central banks cut interest rates to near zero in 2020. They injected trillions in liquidity within weeks. Today, they have far fewer tools. Rates are still elevated, balance sheets are bloated, inflation is persistent, governments are in deficit, political divisions limit interventions. The IMF is worried because the next crisis might hit when central banks can no longer save the system. The new danger: fragmentation. Before 2008, the world was financially unified. The US, Europe, and China were aligned in crisis response. Today, the landscape is fractured: US versus China, BRICS expansion, Russia sanctions, Middle East conflicts, European deindustrialization, the Global South's debt revolt. A fragmented world is harder to stabilize. The IMF warns that globalization's breakdown means future crises will be harder to contain. Who is most at risk? The report highlights several sectors and regions with elevated risk. 1. Commercial real estate. Office vacancies remain historically high. Loans tied to these properties are souring. Regional banks in the US, UK, and EU are heavily exposed. 2. Private credit and shadow banking. This sector has grown from $300 billion to over $2.5 trillion in a decade. It is largely unregulated. One major failure could cascade across markets. Emerging markets. Many countries face dollar shortages, high debt repayments, weak exports, capital flight, and rising political instability. A sudden shift in risk appetite could trigger a domino effect of defaults. The United States.com but fragile. The US looks strong: rising stocks, strong jobs. But underneath, federal debt is at a record, corporate leverage is at a record, household credit card debt is at a record, treasury auctions show weakening, and the Fed is trapped between inflation and recession risks. The IMF warns that if confidence breaks, even the US could face a rapid tightening shock. UK and Europe: debt plus stagnation equals toxic mix. The UK and Europe faced a different problem: slow growth, stagnant productivity, aging populations, high energy costs, deindustrialization trends, and high public spending. The IMF sees Europe as particularly exposed to banking stress, real estate weakness, energy volatility, political fragmentation. One major bank failure, and the EU stability could be tested. What could actually break first? 3 events could instantly collapse today's fragile calm. 1. A major bank announces losses: real estate exposure. This could trigger a liquidity freeze. A large emerging economy defaults: Pakistan, Egypt. Bond markets would panic. 3. A geopolitical shock: war, expansion, sanctions, escalation, energy and commodity spikes would break weak economies. The IMF's message is clear: we don't need a big spark, just a small one at the wrong time. The calm before the crash. Every financial crisis has the same feeling right before it breaks. Markets calm, risks ignored, politicians confident, investors euphoric. Warnings dismissed. The IMF is not predicting a crash tomorrow, but they are telling us that the global financial system is stretched, distorted, and more fragile than it appears. The calm isn't reassuring. The calm is concerning. If you want to understand what comes next, follow this channel before the next shock hits. Because, as history teaches us, the moment everyone feels safe is usually the moment just before the fall. Is this the calm before the crash, or the final warning before the world wakes up?